Get the power to do more with Storable Insurance. More offering, more enrollment, more protection for you and your customers. Storable helps operators do more with the most powerful technology in self-storage. Learn more at storable.com/do-more.
Quick introduction. My name is Matthew Beal. I am in the product marketing department here at Storable. And I want to quickly just give an overview of kind of what we've been discussing over the last couple of weeks and set a little bit of a groundwork for today's discussion. But I'm going to move quick because I really want the stars of the show here today to be able to kind of share their wisdom with everybody. But there's been four main market forces we've been tracking. I'm actually going to go ahead and skip over the first three because we've been covering these for the last few months. But I want to focus on the one that we're discussing today, which is this concept of market corrections. And so what I mean by market corrections, for those that attended last month, this will be a little bit redundant for you, but I want to give a real quick view into what we're talking about here. So when we say market corrections, there's a few main kind of macroeconomic forces that we've been tracking that kind of indicate that we're due for a little bit of a market downturn. And I think we've been seeing that pretty actively over the last 6 months here in the US economy. And some of those things that we've been discussing are things like an inverted yield curve, which is this indicator of kind of how we value short and long-term US bonds. And what you can see here, this is the yield curve plotted, and this red line is 0. And so what we mean by inverted is that when it dips below this 0, this has been an accurate predictor of the last 7 recessions that we've experienced in the US. And so the three that I would point to in particular are the one in the mid to late 1980s, which we all know was a really rough one. The one in 2008, which is kind of the most recent recession we talk a lot about. And then as you see here, we just recently I think it was November of this past year, we had an inverted yield curve for the first time. And this is the most update data I can find, but it actually has continued to dip a little bit below this, and it's kind of stayed below it. So it's seeming like, we're probably due for something. And then in addition to that, there's this kind of the speculative bubble. And so this is just a snapshot of how we look at the speculative bubble, but you guys have seen the broader stock market in a lot of ways has really been suffering over the last 6 months. And there's been kind of what we would call a bubble in the sense that there was a lot of small cap stocks, Lemonade, AMC, and Fiverr, the three that I've captured here, where their enterprise value to revenue multiple was 60, 75, and 105. And for context, we would normally expect that to be somewhere between like a 6 and a 10x. So this is a massive difference in terms of what the market thinks these stocks are worth and what they're actually worth. And as you can see here, over the last 6 months, we've seen a massive correction in those stocks. You get all those major downticks there. And so we've seen that play out across a lot of the big ones, even what's thought of the invulnerable stocks like Netflix, Amazon, these kinds of guys. But as I'm sure everyone's known, the stock market's been suffering lately. And then lastly is inflation and interest rates. So this is all over the news. I don't think this is a surprise to anyone, but we've been seeing 40-year record high inflationary rates. And to combat that, we've seen the Fed consistently bump up rates half a point or even more as of late to combat that. And so all of these things have impacts on the broader market, but also potentially could have impacts on things like lending and our ability to build new facilities, and it impacts the industry in a lot of different ways. And so this is what we want to talk about today is, great, there's all these different indicators of what's going on in the market. What does that mean for us? What does that mean in the self-storage industry? Well, interestingly enough, one data point I want to share real quick, and we're actually going to start today's conversation just in a moment with this, is you can see here that at the beginning of the year, the 4 out of the 5 big self-storage REITs started their guidance with these top lines, this 8 to 10% for CubeSmart, et cetera, et cetera. And in Q2, all 4 of these actually increased their guidance. And what this is same store year over year revenue growth. So even though we're seeing these stocks decrease, including self-storage, these 4 self-storage stocks, by the way, we're seeing that they're actually increasing guidance on revenue. And so there's a little bit of a contrast there. And so we want to have that discussion on how do we reconcile these two things? Things look great for storage. They look a little rough in the broader market. What does that mean? So I want to introduce today's panelists. So we have Raheem Amer, President at Minimall US, and Nick Newcomb, the Chief Operating Officer at StorageMax, who bring with them a wealth of experience, many years and a whole bunch of expertise in this space to kind of help us make sense of these things and kind of get a feel for how they're thinking about the future for the self-storage industry. So Raheem and Nick, we appreciate you joining us today. Would you guys mind start with a little bit of introduction? And Raheem, I'll throw it over to you first.
Sure. My name is Raheem Amer. I'm the president of Minimall Self-Storage. We're an international company. We started expanding in Canada in 2020. And then in January of 22, we started expanding into the US. We started the U.S. expansion at 55 properties in Canada. Currently, we're sitting at about 106 properties in both sides of the border, with another 30 sites coming on board in the next 30 days, 30 to 60 days.
Thank you, Raheem. And Nick, what about you?
My name is Nick Newcomb. I'm CEO of StorageMax. We are locally owned here in Jackson, Mississippi. We currently own and operate 27 stores across the Southeast and can plan to continue to expand within that footprint.
Awesome. Thanks, y'all. Well, let's jump into today's conversation. I've got a few questions. So we just kind of went over this, a little bit of a interesting kind of dynamic where we're seeing that, you know, REITs in particular, who we have publicly available information for, they're increasing their guidance while the stock market, even their own stock, is kind of diminishing. And so my first question for y'all is, like, are you guys seeing kind of some of the same similar growth projections at your own companies at the scales that you guys operate at? And what do you kind of attribute the increases that the REITs are projecting, and maybe your own facility, your own portfolios are projecting as well? And so Raheem, I'll throw it to you first.
Sure. You know, one of the correlations here, a story comes to mind, is my grandfather used to say that you cannot control what other people think of you, but you can control what you think of other folks. And I think that sort of plays into this analogy here, is that the stock market is predicting what other folks think of your brand, but their projections for the REITs is what they think they can do. And at 10%, you know, I just attended a seminar with Marcus and Millichap, and they were talking about how across the self-storage market in the US, average rates are going up about 9%. And with the REITs and all the operational excellence that they have, the data that they have, they're much more aggressive. So I think at 10%, they're being very, very conservative.
Yeah,
Nick, I would agree. It seems like the drop in stock price is on par with the current market conditions, and it's less of a drop than we're seeing in some of the bigger enterprise companies. So it still holds true that even the self-storage REITs are more resilient during a downturn. However, the increase we're seeing is definitely on par with what I think even the smaller players in the industry are tracking. Currently, year to date, we're north of 15% same-store sales growth for stabilized assets, and that's up about 4% from last year.
Mm-hmm. Yeah, and Raheem, what about your specific portfolio too? I mean, you give a lot of credit to the REITs for operational excellence, but I know for a fact that that's also your game. How is your portfolio looking right now? And are you brought up rate increases as a big driver of that? Is something that you guys are still being aggressive about as well?
We are, and again, because we are a very young team, and the rates that and the acquisitions that we have had, there's a lot of mismanagement from those individual operators on their rates. So we tend to be a lot more aggressive on those rate increases. So we're definitely in the 20 above 20 range on rate increases. But again, you got to take that into account, that we're taking sites that have been completely mismanaged, didn't have operational excellence in there, and when we add technology and we add all of those, we can be much more aggressive.
Yeah, and I want to come back to the rate increases here in just a moment, because I do think, you know, in our discussions before this session, I mean, that seems to be a key indicator. It seems to be a key thing that a lot of people are continuing to focus on. Before we get into that a little bit more, though, I also just want to kind of ask your guys' opinion. And Raheem, I think you gave yours, but maybe I'll go to Nick on this one, which is just to say, how are you kind of reconciling this difference between what we're seeing in the REITs portfolio versus the broader market? Is there anything else you wanted to add on that topic before we moved on?
Well, the experts are looking at the overall stock market, and when everything else is dropping, it's hard to attribute a rising stock price, even though they're increasing their projections. So I love Raheem's analogy. The REITs can't control what their stock price is doing, but they're going to continue to put out their expectations. And if they're increasing their expectations, they must be pretty strong on that, because if they miss those, it's going to hurt their stock price even more. So that means that they feel very good about pushing their same store growth up even higher, that they're going to hit those expectations.
Awesome.
And Matt, we saw something similar in 2008, 2009 when we went through the closest recession that we had in the past, right? And I think stock market always has a discounted opinion of self-storage, and I think that each time this happens, they're learning. Back in 2020 when we had COVID, everybody went bananas on that one also. It's like, oh my God, what's going to happen? What's going to happen? And you saw stock prices dive down. And we have, in the last 2 years, I think self-storage has done wonders and has some record increases. But I think each time the folks in the stock market, they sort of underestimate the resilience of what self-storage can do.
Yeah, I think that's a great call out. And I think one thing that I mentioned in the early part of the call, just for the audience's kind of context, is what Nick and Raheem are referring to, kind of the easiest indicator of that, and this is why we've presented this in the webinar, is that enterprise to value ratio. And the idea is, how much revenue are you producing, and then comparing it to how much your company is worth. And so if that number is significantly inflated, that's kind of proven that over the last few years, the stock market has made a lot of mistakes, right? We have overvalued assets across the stock market. And so what we're seeing today is a really, really big correction of that, but it is all based off of investors' opinions on these things. And so I think what's an important takeaway is that there is opinions for sure, but there are also realities, and that is what we're seeing in these same store growth projections and all the things Raheem and Nick are bringing up. And so I think that's important, that's a really strong sign for us over the next couple of years, I think, here in the industry. So I do want to go a little bit more into the rate increases in particular. And so I'm actually going to focus first on occupancy, though, because I think they're so closely tied together. Because as we think about rate increases, they are traditionally something that becomes more aggressive when we are at very high occupancy percentages, because the idea is, we will get out some of the people that are a little bit more cost conscious and make way for a line of people you have out the door that are potentially waiting for a unit. And so we know in the industry, we've seen over 90% occupancy across the board nationwide for the last couple of years. It's been really kind of record-breaking occupancy levels. So my question to y'all is, do you kind of expect that to continue? Do you think there's any early signs that maybe we're going to see occupancy dip a little bit? How are you guys thinking about that from your vantage point? Nick, I'll throw it to you first.
Well, I think we all know self-storage is such a micro market, so you can't look at even one city in particular as a whole and decide what occupancy is going to do. If someone builds 150,000 square feet across the street from you, of course that's going to have an impact on your occupancy. However, we are still seeing increased demand far more than we have in current supply in all the markets we operate in, and I think in most around the country. So I don't think, even with rising interest rates, the housing market slowing down a little bit, I think we have more more demand that's going to outpace supply. So our physical occupancy last year, we had 8 of our properties hit or get to 99 to 100% physical occupancy, which, as we know in the industry, you don't want. Our golden number is typically 92 to 94. So we have been more aggressive with our street rates this year, more aggressive on our revenue management side for the tenant rates. And we're keeping it closer to that golden number of 94% of where we want to be, even during the stabilized months through the summer. So I think we'll continue to see that for a while.
Okay. Raheem, what about you?
Yeah, same thing, right? I mean, as Nick alluded to, there's a lot of backlog and blockages in global supply chain going on right now. And, people can't build self-storage fast enough. And with the high occupancy that we have, I think we continue to see that, because there's nowhere else for these guys to go. As you've seen the industry, 90% of the business out there are doing some kind of a hybrid model where people are still working from home. And if they're going to continue to work from home, and people are moving, and you're seeing a huge migration to the Sun Belt. So it's creating demand for storage, not just in the Sun Belt areas, but also from where they're moving out of. So all of that is creating demand. And I think that's going to continue over the course of the next 2 to 3 years.
Yeah, I love that so much.
That's why you see a lot more institutional money going into secondary and tertiary markets, because people aren't living and need the urban setting anymore. So it's really helping the secondary and tertiary stores.
Yeah, the reason I love that so much, and I know you guys wanted to kind of bring this up when we talk about rate increases in a moment, so just to kind of maybe segue here, is that this idea of not necessarily thinking of your customer base or your stores as kind of a monolithic thing, meaning that every store across your portfolio is necessarily the same. Now, I know a lot of people on this call, a lot of the people attending might only own one store, and so this is kind of a lost point, but it actually isn't. Understanding kind of where your facility is, in what types of markets, what the types of things that the customers in your surrounding areas that are coming in or leaving might actually have needs for storage is a really important thing. And Nick, I'm actually going to throw this one back to you because I think you were the one that brought up this idea, but my question is now kind of transitioning towards rate increases, which is to say, I know one of your considerations is that you don't necessarily leverage price increases the exact same way across your entire portfolio. It's much smarter to be kind of targeted and intelligent about the way you go about that. So would you mind kind of unpacking how you guys have been thinking about doing that at StorageMax?
Yeah, absolutely. I hear the question all the time when someone buys their first location or even second and third. They want to get feedback from others. How do you do your initial rate increases? Do you raise everybody $5 or raise everybody $10 or just go ahead and bump them straight to market rate? But you really can't look at the facility as a whole. We look at silos. So every individual size and type is its own product type, similar to milk or the frozen food section at the grocery store, have no correlation on price to each other. So you should be looking at your 10 by 10 climates different than your 10 by 10 traditionals. And if one is full, you push that one higher than one is 80%. So don't look at the facility as a whole. Look at it in silos, and then you can do different percentage increases based on the occupancy of that silo.
Mm-hmm. Makes a lot of sense. Raheem, what about you? How do you think about that general idea?
No, we do the same thing, right? We call it buckets, so we look at each individual bucket and see what the occupancy is of that bucket, what the length of stay LOS is of that general customer base in that bucket. And then we also look at what is the demand that's coming in, right? Is there a lot of demand? A lot of folks looking for a 10 by 10 unit, but they're not finding on our website, on our webpage, on our landing page, so they're moving off. So we track those things, and that tells us that there's a lot of demand, and whatever rates that we have on those in those bucket types, those need to change because we have people that are potentially, there's a waiting list of folks that want to get into that unit type. Mm-hmm. So that helps us decide how aggressive do we want to be.
Yeah, that makes a lot of sense. Well, what about the frequency of rate increases? I know there was a spirited conversation on this as well, so I thought it'd be good to kind of shed a little bit of light. Raheem, I'd like to start with you and kind of, actually, I'm going to go to Nick first intentionally on this one. Nick, would you kind of mind walking us through how you started and thinking about it? And then I know Raheem kind of even made me change your mind a little bit about how you think about it, so we'll get to his POV as well. But starting with you, Nick.
Yeah, absolutely. When you hear people talk about how they're doing rate increases and the percentage they're increasing, you also have to think about the frequency, because some people may be doing 6 to 8% increases, but doing them multiple times a year. We've always been with the model. We offer our tenants a 12-month price guarantee, so we do rate increases once a year. It's very transparent, and we feel good about it, but therefore our rate increases have to be higher in order to keep up with market demand. Our rate increases are roughly double what they were last year. Our attrition rate has risen from about 4.6% to 7.2%. So the move outs have not doubled with the amount of increases. But right now we're averaging at about 15.6% rate increases on existing customers when we put them in place.
Awesome. And then Raheem, I know you had a little slightly different POV. Would you mind sharing yours?
Yeah, I had a slightly different opinion on that, and mine is based on, rate increases are based on what the gross potential revenue, GPR, is of a particular unit type. And self-storage is very cyclic. So there are certain months of the year where your GPR tends to be lower, and then there's certain months of the year where your GPR tends to be higher. So what we like to do is at least do it every 8 to 9 months. So that way, every 2 increases, the customer is actually falling in a different cycle in the year, and we tend to be a lot more aggressive in those months versus when in certain other months in the year.
Yeah, very good. Well, hey, there's a follow-up question on this too we got from the audience, and Raheem, it's specifically for you, but Nick, we'd love your input if you have any on this one as well. But the question is around. Raheem, I think this is in relation to the fact that you're talking about when you're doing price increases, you're looking at specific buckets, was the word you used, whether that's the type of unit or whatever it may be. and you're trying to identify, when kind of you're at a high occupancy percentage of that, or maybe there's a long line of people that are behind them in terms of what kinds of units they've been searching for. And so the question is about kind of understanding what your tenant behavior is. How do you identify what people are searching for? How do you know what types of units are in demand? Do you have a wait list? Are you using some sort of software to track that? How do you go about doing that?
Both. So there's a wait list usually on a site level for folks that are coming in, but then we also capture where customers are landing on a page and which units they're looking for. And we also look at the bounce rate of on a unit type when they land on a page. So all of those and where the cursor goes for a customer, what they're looking for, all of those play, and we collect that data and we feed that data into our decision-making process.
Nick, anything else?
Website data is key for that. You can use simple Google Analytics to look at raw website data and see where they're landing on your website, if your website company isn't currently providing you that. As well as we have a revenue management software we use that projects based off historical demand. Every time we open up our screen to do rate increases, it tells us projected demand over the next 30 days for each unit size and type. So that kind of gives us our demand we think we're going to have and helps us drive how much we should drive that unit's price.
I would be careful on that one though, because this is one of the things that the REITs have learned, is that because again, over the course of the last 10 years, their revenue management platform depended on looking at that data, looking at that history and trying to figure out and predict what's going to happen in the future. And what they found out quickly as COVID accelerated is that all of their prediction models got thrown out the window, because it was predicting one thing and they were doing something else. And they found out that their increases were not jiving with what was happening with reality. And they quickly made some adjustments on that. And, so looking at whichever model you're looking at, you have to keep in mind that the pandemic has thrown that completely off. And if you're still looking at your 2020 data or 2021 data and trying to predict what you're going to do in 22, things are changing. Things are changing dramatically. So you need to be careful about that.
2020 was a reverse effect of what we see in normal years. The fall and winter are typically our slower times, and the fall was our busiest time in 2020.
Interesting. Yeah. Well, guys, in the interest of time, I want to jump to one more. Actually, I have two more questions I want to ask y'all. One of them is around going back to kind of these broader market conditions. The other thing that we discussed in our last webinar is that this potentially could impact tenant behavior, right? Whether it is, we've already seen in the tech sector, there's been mass layoffs. A lot of companies that are receding, taking back offers and not taking people on. We're going to see kind of more layoffs in certain industries potentially. So you might have some people that, are having to kind of downsize or move out into a different area or whatnot. And we know these things, these life decisions impact tenant behavior in the self-storage industry. So my question to you, just keeping it broad, is how are you guys thinking about like what might potentially change from a tenant behavior, and how is that going to impact your operations? So Raheem, I'll throw this one to you first.
Yeah, that's one of the things about, and one of the reasons why I love self-storage is that, we did a survey on this thing where we interviewed tons and tons of customers, people that had never stored, people that had stored in the past, people that were current customers. And we found out that an average customer thinks that at time of move-in that they're going to stick around for about 2.5 months, 2.6 to be accurate. And they actually stayed for almost 11.5 months. And I can tell you that data is about 2 years old. And all we have done over the course of the last 2 years is just elongated that gap between those two. And I think that's one of the things I love about storage, is it gives us that ability. We're a month-to-month company. We can raise rates as often as we want, as aggressive as we want, depending on the demand that we have. And customers have to think 3 times before they move out, because every single time somebody's thinking about, hey, you know what? Nick moved me from $50 to $55. For that $5 bump, I have to go rent a truck, find 2 buddies, take my weekend and destroy it, because I need to go out, unload everything, take it to a different property, put my stuff all back in, all for a $5 increase. And what we find out is people think about it twice and they move on and they stick around. And that's what happens over and over and over again. One of the best things about self-storage.
What about you, Nick?
I would agree. I mean, definitely consumers are going to try to cut costs. However, as long as we still have demand outpacing supply, we will see maybe a small amount larger move outs than we've seen in the past. But my street rates have risen on average 40% over where they were this time last year. So if they move out and we're continuing to re-rent those units at a higher rate, we're completely okay with it. I will say, even though we might see the housing market slow down a little bit, we'll keep the demand we need. People don't want to get rid of their stuff. Their items they love are in our storage units. And the reason they're putting it in our units is because they have nowhere else to put it. So it's not only the decision of cutting the cost, but it's, do I really want to throw all this stuff away or donate it somewhere or sell it? And most of the time that answer is going to be no, because they put it there for a reason.
Mm-hmm. Yeah, interesting. Well, guys, there's one question I'm going to end it off with, and I've intentionally been ignoring this, but I will tell you I've gotten 5 separate questions from audience members on this one, so saved it for the best for last, which is around the idea of asset valuation. I think that's a pretty common question that people are getting right now, is in these conditions, as things like interest rates rise and the cost of capital is going to increase. Is it a bad time to buy? Is it a good time to sell? Is it a bad time to sell if the market starts crashing? Just trying to help kind of make sense of all these different kind of conflicting data points. So I'm kind of curious how you guys are thinking about that just from a high level, from an asset valuation standpoint. And so Nick, I'll throw that over to you first.
Okay. Mainly don't over leverage yourself. It's definitely not a bad time to buy. I've seen this all over the place. Millionaires are always made in the lower ends of the market cycle. So you could definitely do well if we do see a downturn, which I don't think we're seeing yet. Interest rates are rising. I have yet to see that impact cap rates. I think we're still seeing a little bit of cap rate compression, and we're going to continue to do so as long as there's still institutional money coming into our industry at the rate it's been. So even though we might see an overall stock market decline, there's enough demand for our industry that I don't see our asset values being hurt much unless interest rates continuing to rise so much that we'll see cap rates adjust. However, it's all based off your NOI. So if you're still continuing to grow revenue like you should still keep the value of your assets stable, if not growing.
Yeah, that's a great point. And just throw it out there. A lot of what we've discussed today, what a lot of the knowledge Raheem and Nick brought to the table is how can you maximize that NOI even in the shifting market conditions. So that's a great call out, Nick, just to kind of bring that full circle. Raheem, what about you?
Yeah, I agree with Nick on that. And the only thing I can add is, look, if you're trying to sell to mini mall, this is a great time. If you're trying to sell to somebody else, it's a horrible time. Don't do it.
Cap rates will rise. If you're thinking about selling, do it now. Call us.
Very good. Well, y'all, I really appreciate you guys coming. It is 11:30 Central here on the dot. So I want to be respectful of time and go ahead and kind of wrap up the webinar today. But any kind of last thoughts or anything you guys wanted to share with the audience before we do so?
No, thank you for having me on. I appreciate it. I think this is a great topic. It's been a topic that's really taking on some traction, and it's been a regular conversation piece in many different meetings and stuff. So it's a great conversation to start up.
Awesome.
Yeah, absolutely. I look forward to seeing where you continue to take this series, Matt. So enjoyed having me on today, and I look forward to the next one.
Awesome. Well, guys, thank you so much. We appreciate it.
Thanks,
couple quick last minute items just for the folks in attendance here. So, obviously we threw a couple questions in there, but you guys did submit a lot of good questions and additional. So I will be following up with everybody individually, and a couple of these were kind of targeted more towards our panelists. So I'll consult with them and make sure we can kind of get their POV on some of this stuff. But we appreciate you guys contributing and participating in today's session. We know this is something that's on top of a lot of people's minds. So appreciate you guys showing up. We do this for you guys. With that being said, I wanted to talk a little bit about what's up next for our Storable webinar series. So in the end of July, about 30 days from now, we're going to be doing another Storable deep dive. On the topic of adjusting your marketing in this declining market. So we talked a lot today about kind of the operational impacts and how the panelists are thinking about that portion of things as it relates to a declining market. But there's also some things that you can start thinking about on the marketing side. And kind of as a teaser, a lot of what Nick and Raheem were talking about being very targeted and understanding the nuances of the different tenants and the unit types and what you need to do. That's a lot of kind of how you can do excellent marketing in this conditions. And we're going to kind of be able to provide some guidance and some tips on how you might be able to do that. So don't miss that session. We'll be sending you guys emails with more information and the ability for you to register and watch it live, or if you can't make it, we'll be able to send you a recording. But with that being said, just wanted to again thank everybody here in attendance. We do this for you guys. We appreciate you can continue to show up and participate. If you guys do have any questions between now and the next session, just email webinars@storable.com and we will get back to you as soon as possible. But otherwise, hope everybody has a great weekend and we'll see you guys in about a month. Bye.
Bye, everyone.
Get the power to do more with Storable Insurance. More offering, more enrollment, more protection for you and your customers. Storable helps operators do more with the most powerful technology in self-storage. Learn more at storable.com/do more.